Welcome back to Curious Commerce, dear learners. Working Capital Management, continuation from part 7. This session, we will discuss about working capital management in hotel industry briefly and the sources of working capital. Welcome back to Curious Commerce. A hotel looks beautiful, rooms are ready, staff is present, kitchen is running. But hotel owner says during season, full booking. During off season, cash problem. Why does this happen? Because hotel businesses face a serious working capital challenge. Today, let us clearly understand working capital in hotel business with three realities. The first reality is seasonal income. Second one is fixed expenses always. Third one is off season cash shortage. Working capital means the money required to run daily operations. In hotel, it includes staff salary, electricity, it includes AC, greaser, lighting, etc., water and laundry expenses, kitchen supplies, maintenance and housekeeping, marketing and online booking commissions. Hotel must spend money every day, right? But income does not come equally every month. It will be changed. That's fluctuating. That creates imbalances. The seasonal income, the biggest reality of hotels. Hotels depend heavily on tourist seasons, holiday periods or holiday packages, wedding seasons, and business travel seasons. During peak season, rooms are fully booked, restaurant is busy, event and parties increases, revenue flow is too strong. But during the off season, rooms remains empty, event bookings reduces, restaurant footfall drops, income falls sharply. So, hotel income is uneven, unpredictable, and highly seasonal. This create working capital stress. The second one is fixed expenses never stop. Even when guests are few, hotel expenses continue. Every month, hotel must pay staff salary, electricity bill, internet, software systems, maintenance, repairs, bank EMIs, property rent or loan, etc. These expenses are fixed, continuous, and unavoidable. Hotel cannot tell staff this was no guest, no salary, right? So cash must be ready regardless of income. Third one is off season causes cash shortage. Here is the real challenge in the business of hotel industry. During the peak season, hotel earns well, good cash inflow, business looks very healthy. But during the off season, income drops, expenses remain constant, cash reserves get used, working capital dries up. Many hotels struggle not because of business is bad, but because they fail to manage cash between seasons. Smart hotel owners save surplus from peak season, maintain cash buffers, control expenses in off season, and plan working capital in advances. So remember these three hotel business truths. Income is seasonal, expenses are permanent, off season creates cash pressure. Hotel success is not only about luxury rooms, it is about smart financial planning. A successful hotel is one that manages cash during bad months using profit of good months. Many businesses fail not because they are making losses, but because they run out cash. Sales are happening, profit is shown in books, but still business collapses. Why? What is the reason? Because working capital is not available at the right time. So today we will understand a very important topic, sources of working capital. Four practical sources every business uses: trade credit, bank finance, short term loans, and customer advances. This is not theory, this is real business survival knowledge. Working capital is the money needed for daily expenses, stock purchase, salary, rent, electricity, transportation, and operations. But where does this money come from? It is called sources of working capital. A good business is not one that only earns profit. A good business is one that arranges cash intelligently. Trade credit, the most common source for the working capital. Trade credit means buying goods today and paying later. For example, a shop buys goods worth rupees 50,000 from wholesaler. Wholesaler says pay after 30 days. That 30 days is free finance. This is trade credit. So the common doubt, why it is powerful? What is the speciality in the trade credit? No interest cost for the trade credit. Easy availability. It is just a contract between the two people. Sometimes it is a oral contract. Improves cash flow. Helps small business survive. Almost every businesses use trade credit, like retailers, wholesalers, factories, and distributors. But danger is also there. If you delay too much, suppliers' trust reduces. So smart businesses use trade credit carefully. Second one is the bank finance as a formal support system, or it is a traditional. When internal cash is not enough, businesses go to banks. Banks provide working capital in many forms, namely cash credit. In banking terminology, they call it as an CC, overdraft, or OD, working capital loan, bill discounting, and short term business loans. For example, a factory needs rupees 20 lakh for raw material. Bank gives CC limit, cash credit limit of rupees 15 lakh. Business uses it, pays interest only on used amount. Bank finance helps business to handle big orders, manage seasonal demand, pay salaries or the emergency commitments, run operations smoothly. But remember, bank money is disciplined money. Document required for taking the financial assistance from the bank. It includes the interest cost. Sometimes it creates repayment pressure also, and regular monitoring is essential. So it must be used wisely, not emotionally. Third one is short-term loans. Short-term loans are quick but costly. Sometimes businesses need urgent money, emergency money, salary payment tomorrow, but it's too urgent, right? Suppliers demanding for payment, emergency stock purchase for operations activity, and unexpected breakdowns. Then they take short-term loans. The major sources for the short-term loans are NBFC, non-banking financial corporations, fintech apps, private lenders, and microfinance institutions. They are the sources for the short-term loans. These loans are easy to get, very quick approval, and less documentation, almost no documentation at all. It is almost 100% paperless. But the danger part is the interest rate is too high and the repayment period is too short. The trap of the short term loan create the emergency in the debt cycle. So, rule is simple: use short term loans for emergency, not for habit. The fourth one is advances from customer. This is the best sources of working capital. Customer pay first, business deliver later. For example, advance booking for hotels, advance for construction work, token advance money for flat, advance for event management, pre-order for product and subscription models. Here, business gets cash first, right? No internet cost, no bank pressure, no repayment tensions. Generally, big companies like Amazon, Zomato, Ola, airlines, and some coaching institutions all use customer advance model. Smart businesses design their models so that customer funds the working capital. So remember the four major sources of working capital: trade credit, just for suppliers support you. Bank finance means formal system supports you. Short term loan, it is an emergency support system. Customer advances, best and smarter support for the business. Business success is not just about the profit, it is about cash timing, cash planning, and cash discipline. The entrepreneurs who understand working capital never fears about the business growth. Thank you all. For daily updates, follow WhatsApp channel, Curious Commerce Financial Management Hub. The topic working capital management will be continued in part 9. Like, share, and subscribe to Curious Commerce. Thank you all.